Good morning, everyone. Myself, Durgeshwar Mishra. We, I have been assigned to moderate this session. So I would like to thank Dr. Ravi Gupta, the elite team, for organizing such a wonderful event. And the vision of Mr. Gupta is really commendable, where he is thinking for a developed country in years. So technology is going to be really game changer for everything. So if you remember, I remember the days when there was no 3G, 2G, and simple mobile phone was there. And before that, the telephone landline where we have to book trunk booking if we have to do STD call. So if you have to call, even in India, at some locations, you have to book a trunk call through tele department, and you will be assigned a time slot and they will connect you. So if you, most of the people in the hall, they must have experienced the same, or well, it would be proportionately. So people in our age, they must have experienced the same, but the new generation, they never knew, in fact, what happened. They started their journey with very smartphone. But yes, every growth has a path and challenges. So it was not so seamless to improve the whole ecosystem from normal landline to 5G phone, where we can do all the things in one go through our mobile. So that is the really topic we are discussing today, the challenges, and we have specified the regulatory challenges, because most of the things, it has to be under a very regulated environment. Only one we can protect the customer and the interest of the all stakeholders. So that is a very important thing, and government and other SROs and other agencies, they are doing the same thing to ensure that we are growing at the pace, but at the same time, we are not compromising with any sort of client or any stakeholder interest. So that is the thing. I must introduce our panelists. Their name is here, but Mr. Satish, next to me, he is leading one of the microfinance institution based in Gujarat. He is heading the department of, sorry, technology, sorry. So he is a technical guy, and he has done in the past also, he has co-founded one technology company. So he has seen a lot of phases. So his experience, his word would be really helpful to us to understand. And next to me, Sanjay ji. Sanjay ji is heading mid-size NBFC, infrastructure finance NBFC, and he is he would be enlightening us on the various problems. So I would like to highlight here that we have a mix of all sort of entity, where we have a big NBFC like Hero FinCorp, we have infrastructure company, Sanjay ji is representing, and one P2P company. You must have heard about P2P company. For that, RBI has given a separate regulatory environment where they can take money directly from investor and lend to the needy customer. And that is truly technology-driven platform where one can monitor on time everything, so real time sort of progress and all. So we have a very good mix. So my question to Mr. Rohit would be, Rohit is heading IT in data in Hero FinCorps, that most of the company, like big company, they are doing, taking a lot of technological thing to improve, as Mr. Gupta has said that it is increasing 90% efficiency on the client sourcing and all. So lot of companies are taking, but how you see that these technological help are, of course it is enabling the cost and sourcing time and everything, but at the same time how you are coping with the regulatory requirement, where I have experienced that lot of regulatory, the frequent changes in the regulatory environment. So I would like to understand how you manage, or how you ensure that these are our things in the regulatory framework and regulatory ambit.
Sure. Thank you. Thank you. Thank you for having me here. So, hello. Yeah. First of all, thank you. Thank you for having me here. From the question that, how regulation is impacting the digital transformation for NBFCs. First of all, RBI regulations are paramount, wherein all the NBFCs have to follow that. And touching about the same point which Mr. Durgeshwar have just mentioned, that the world earlier was different as against what it is today. So if we talk about 5 years earlier, then the digital transformation which was happening at that point in time and what is happening today is completely different. If some NBFCs were able to do the digital transformation at that point in time, then it was giving an edge to them as against the competition. But now it has become the basic necessity. Having said that, following the RBI regulations along with the digital transformation is very much possible. So there are various means to it. Suppose we are going ahead with the digital transformation in an organization. First of all, we have to involve all the stakeholders, right from operational risk management to information security, compliance, legal and audit, for us to be very sure that, we will not be going ahead with any wrong thing, and everything is compliant as per the RBI regulation. And the foremost and the most important thing is government have invested a lot of money in last 5 to 10 years on the digital infrastructure of India. If we talk about some of the initiatives like ONDC, OKN, wherein there is a retail and commercial lending digitization which is happening. Then there is account aggregator which is integrated with OKN, and it can be used standalone also within the NBFCs. Apart from that, there is TREDS. In TREDS, it is specifically for supply chain finance, wherein there are 3 entities who are enabling it with the NBFCs and the banking partners. So likewise, there are multiple digital infrastructures available in the market, and all the NBFCs should be able to integrate with them and should be able to leverage that. That's the easiest way to be going with the digitization journey, and along with being compliant and giving the great customer experience. In the past, we have seen India Stack, which has been very, very successful, wherein UPI have been very successful. It is getting implemented across the globe, and likewise, these things are coming up big way. So that is my take on that. Along with that, there is a data. Why RBI is doing it? Because of the data protection of the customer, because customers are taking services from us, and it is a paramount responsibility to secure their data. So in order to secure their data, we have to comply with certain regulations. Now there is DPDP Act, which has been approved last year, which is going to be implemented this year. So that is coming up big way, wherein there will be a data protection officer, which will have to be employed within the NBFC. Along with that, the best way to secure the customer data is cloud computing, wherein the data can be stored in the cloud and which is secured by a firewall. And there's a big data. Using the big data through AI/ML technologies, we will be able to provide the personalized customer experience even to the new customers. So, in a nutshell, according to me, RBI regulation can be very easily followed along with the digital transformation of the organization.
I would like to add few points here. As Rohit said, the RBI regulation is moving around this sector, but more critically, post digitalization, the number of data is moving in a different directions, and it is a need for built-in controls at a various stages, even through the loan life cycle, since deal origination till maturity. As you know, in the microfinance business, there are customers are in millions or the billions, and the transactions are happening in millions a day. It's not possible for a human to track all those transactions. It's only the tech-enabled solution which helps the companies to build in control and to ensure that all the things are going in a right pace. The RBI is more stringent. They don't want any NBFC fails to deliver or put themselves in trouble at a later stage, and that is the reason RBI build up so many regulation, whether it's an outsourcing policy, whether it's reporting of the financial numbers. These are the things very important from that perspective, and we have to take it forward.
Thanks, Sanjay. I would like to add two regulations which are most important for this. One is the Master Directions or Information Technology Framework, which is applicable to all the NBFCs. So NBFCs, there are two sections, Section A and Section B. Section A is applicable to the NBFCs which are having asset size of more than 500 CR, and Section B is applicable to the NBFCs which have less than 500. So while you're going in the digital transformation journey, you need to adhere to all these directions. Apart from this, RBI recently came with the digital lending guidelines as well. So when you are moving towards a digital transformation journey, please take a look at these guidelines clearly and implement all those points into your digital transformation journey.
Thank you very much. So I'm hearing that the way regulator want to ensure that data, information, and the flow, it should be very much aligned in the interest of customer and other stakeholders. We are discussing NBFC, and Mr. Sanjay has mentioned about billion transactions.
Hey there.
It's not only microfinance. If you take a bank, I will again go in the history of just 20 years back where no RTGS, NEFT was there. If you have to transfer money from one bank to another bank, you have to make the DD, demand draft, and it has a time of at least clearing time of at least 4 days, 4 working days. And if you have bank account with different layers, like we have regional rural banks, and if you have to get that in regional rural bank, it will take more than 9-10 days. But today we are uploading billion of transaction in a seat and getting transferred within few seconds. Have we ever thought that how it is being reconciled? Lot of transaction. We are experiencing ATM. We are experiencing payment gateways. We are experiencing wallet. We are experiencing everything. Have you ever thought that because it's our hard-earned money and how it is being routed through them, so regulator has ensured that it has to be in a very safe environment and one should not get impacted because of the technology. So once bank is complied, the next level is NBFC, where we are dealing up to some part of the transaction of banking. Like we are giving loan, we are giving, well, we are providing insurance services, we are providing some other support services. So all the regulatory challenges what we are aiming, in my view, it's very, very required and required to protect the interest of client and other stakeholder. So next question would be like, again on the same issue, I would like to elaborate that yes, you have mentioned that we are doing or we have to do, but what the hurdle you are facing to implement that regulation, that is the key. Because RBI or any regulator, if they have mentioned that you have to do, so that you have to find a way. How ecosystem coping to achieve that desired mandate from regulator. So that hurdle we need to discuss, and what ecosystem infrastructure are the ecosystem has been developed to deliver that. So that is my next question.
Oh, all right, I will take that. So, so look, we all think of regulation as hurdles, right? So first of all, let's quickly understand why do we even think of those as hurdles? Right? Often what happens is what the regulator wants us to do are fundamental best practices that we anyway need to be doing in our business. It's like when you're driving on the road, right? When you come to an intersection, you will stop, you will look left, right, and then you will go. That's just common sense, and you're supposed to do that, right? But the moment the traffic department comes and installs traffic lights and starts putting fines on you for violating them, you begin to think that this is a hurdle now. Why do I have to do this?
Just let me complete. I think I missed one thing. So we want to reach at airport in 20 minutes. That is the hurdle.
Correct.
So we don't count the red light, we don't count everything, we just say that we have to reach there. So the hurdle is coming to achieve your projected plan or any operational strategy, that is the hurdle. So RBI is clear.
Correct. So RBI is very clear, right? We all know that what RBI is doing, the intentions are very good, and we also know that as for our own safety, right? We have to do that. So I'm going to speak from the context of a lending NBFC because that's really what I know the best. And from an regulated NBFC, from a lender, right? There are some things that I know I have to do as good risk practices. So I need to know who my customer is. I have to do KYC, right? I need to know that I can reach my customer when I want. I need to tap into my customer's data so I can underwrite the customer. So all these are things that I would anyway want to do. Sometimes what happens is the regulator comes and wants you to do things that you don't necessarily need to do from a risk perspective. And I think that's what creates this perceived hurdle or, the idea that this is something I don't want to do, right? Let me give you a few examples, right? I need to do KYC in the recent last 5 years. The digital public goods infrastructure, as one of my panelists talked about, has enabled us to do KYC using Aadhaar OTP, right? Fantastic. As a lending entity, I want to onboard my customer very efficiently. I want to do an OTP-based KYC. It's a simple 2-step journey, right? What happens is when the regulator comes and tells me that, look, you can do that, but when you do that, it's a limited account. It's a limited KYC, and your transaction that you can do with the customer cannot be more than 60,000 rupees, right? So the moment I want to do a larger loan, now I have to go into something more elaborate, which is potentially, I have to do a video KYC or in-person KYC, right? Now that immediately changes what my goal is. My goal is to try and onboard my customer very, very rapidly, And now suddenly a regulator comes and says that, okay, you have to do video KYC, which means I have to now go and schedule the discussion with the customer, have to have an agent at the back end who will do this video KYC, right? And then this video KYC needs to be approved in a two-step process, that one person does it and there has to be a maker checker, right? Now that's what creates the perceived hurdle. Another example I'll give you, right? We all think of regulator as only RBI, but there's also NPCI, which has a certain set of rules. UPI autopay is fantastic. I can now start collecting money from my customer using UPI. But wait, there is an NPCI imposed guideline that I have to give the customer a 24-hour heads up on what I'm going to collect from the customer. Now, 24 hours seems okay, but what if I'm doing a daily collection product, right? A daily, what we call the EDI instead of an EMI. Right? I give the customer a notification today that I want to collect so much money from you tomorrow. Right? In between, the customer hasn't paid even today's EMI. So now I need to collect twice the amount from him tomorrow. But I can't because I've only given the customer a notification saying I'm going to collect one EMI tomorrow. Now a customer's gone into OD, will stay in OD, the DPD will continue, right, till I try and fix it. Right? So that's another example of where a well-meaning regulation creates operational complexities for us. Right? Another recent example that came out is the regulator wants the entities to, whenever we update a customer's records in the bureau, we are supposed to notify the customer if we are passing a negative remark on the customer. Right? It's great from the customer's perspective. But for us now, it increases my operational cost. Because now, even though the customer legitimately has an OD, I still have to pay him, pay money to send out a notification to the customer. Right? So there are, I think, a lot of these things which are well-meaning regulations which we need to do, but they create an operational complexity and challenges. Right? Now, I think the important thing in how do you navigate this is to understand the regulator's perspective. The regulator is playing from two fundamental perspectives here. One is customer centricity. The regulator wants to protect the customer, wants to make sure that the customer is not being treated very unfairly by the lender. The second thing the regulator wants to do is prevent a systemic risk. So the regulator does not want regulated entities to come and start doing things which will affect other lenders, other entities in the ecosystem. To navigate these regulatory hurdles, I think if we fundamentally begin to follow these two premises and follow that spirit that you need to be transparent to the customer, you need to make sure that you will tell the customer everything upfront, not have everything hidden, etc. Then I think half the battle is won. The other half of the battle, you will have to win by setting up the right compliance infrastructure in your place, the architecture in place, making sure that you, like one of the panelists said, that you actually take the compliance in picture before setting up your operational process, before creating your products. It means you have to invest, you have to factor that into your cost of doing business. Okay? There really are no silver bullets here to navigating these.
On a lighter note, I just like to say, that's why they have created, now companies have created this post of Chief Digital Officer, where earlier there were CTOs, but not Digital Officer, because Digital Officer does tech as well as compliance. So they are going to mix both tech and compliance and create a system which is compliant with RBI regulations.
Well
Am I right?
Yeah, I would like to add one point here as well. Since the NBFC companies are having a tremendous task of growth and they are doing it very fast, the growth is exponential. And to achieve those things, sometimes they don't have infrastructure. They have to outsource certain activities. And RBI come up with very stringent regulations where it says you need not to, you have to do your in-house checks, compliance, as well as a principal loan giver, you have to ensure the compliance at the third party side as well. And this is creating a little bit challenge in meeting the RBI compliance, because there are certain activities which you are outsourcing. You are putting customer data on the clouds, the cloud server should be in India. Then you are outsourcing certain KYC things. The second person is doing it. There are certain recovery processes which has been outsourced. You need to follow the RBI norms. You should not go beyond a certain level while doing recovery. So these are the steps which where RBI has pitched in and required NBFC to ensure the compliance at every level.
That's right. So I would still say that the regulations which RBI are coming up with, there is a great logic behind that. So just an example of KYC. So up to 60,000, we can go for OTP based KYC. After that, we will either have to do VKYC or a biometric KYC. There is a reason to that because the kind of loan amount which we'll be giving to the customer will be on a very higher side, and for that we really need to meet the customer. So I totally understand and agree to that will be a cost involved over here. However, we have also seen in the past that because of these RBI regulations, our ecosystem, our financial ecosystem have been safeguarded multiple at times in the past when there was a turmoil in the global economy. So these are the regulations which are safeguarding us, and if we follow that, there is a logic behind that, and of course there is a cost to it to provide the customer centricity, but we should follow that.
Yeah, thank you. So, after getting the answer, it is coming out that RBI is thinking for all the stakeholders. Even it is really little hurdle, I would not say little burden to the smaller entities, it could be. But if you are a fairly sizable entity, you can manage all these requirements well in advance, in fact. The problem is smaller entities where they have either they have a big budget for all those things, or they have to go with some sort of arrangement where other institution, they are helping them. Like one thing you have mentioned, a few people have mentioned about the Aadhaar authentication. So RBI give permission to NBFC, UHA, AHA license they are providing, AUA, KUA, sorry, AUA, KUA license they are providing, where they can, NBFC themselves can become the aggregator for UHA ID, and they can check the Aadhaar validation. But getting that in place, you have to have a big budget. So, and that cost effectiveness and cost efficiency you have to understand. If entity is doing good and fairly large, they can establish that system in-house. But for smaller entities, there are institutions, they are providing these sort of support to facilitate their growth and other. So during discussion, it is coming out about the technology. So nowadays, we have two set of companies where one, they have their branches, they have their field staff in the field, they have a loan product, and they have a, you can say the, what we say?
Class.
क्या बोलते हैं इसको? Traditional financial services, providing traditional way of providing financial. They are adopting a traditional approach for providing financial services. So one has to go and visit the customer, do all these things, PD, credit check and all. And with technology, with other these things, like a lot of fintech, we say, entities are coming up with instant loan, 1 minute loan, that sort of facility where no one is there. You have to just apply over your phone, and a few verification related to your mobile number, like if you are doing Facebook, Insta, and like your email and all. So how the whole panel think that's if they are lending to the same customer, uh, is the level playing game in the financial services? Because lot of entities, they have their traditional approach, going visiting client, doing and assessing the risk and all, involvement of 3 4 layer, and coming up with technology. How the panel think about, is it a level player, level playing?
Yeah, of course, because earlier what used to happen if we have to visit the customer for collecting the documents or so to say doing the KYC, there is a cost involved to it. Just to give you a ballpark figure, around about 250 to 300 rupees per visit. At this moment, if I am doing a KYC, digital KYC, I don't have to visit the customer, and that will save a lot of cost, around about 15 to 20 rupees per customer. Apart from that, talking about e-sign, right? Earlier we had to get the signatures done physically from the customer. After getting the loan sanctioned, again we have to visit the customer. Today, we can get the e-stamp done, e-signatures done on the fly. So first of all, the turnaround time gets improved a lot. Secondly, our efforts to visit the customer, the money to visit the customer, all of them is getting covered by this. So, of course, this is giving a level playing field to us wherein we'll be able to approach more customers in a very cost effective manner.
So there is a method to this madness. It's not that everyone is giving instant loan and to everyone. So there is a proper guidelines. They create proper credit criteria that how they are going to give loan, and also in most of the instant loans, the loan amount is not high. It's not high. It's lower. So less than 50,000. Let's say they start with 10,000, then 20, then 30, then 50, and then go on. So you do proper KYC because KYC has to be done. You cannot give loan without KYC. You do proper credit evaluation, that has to be done. Then you integrate a lot of third-party vendors for GST check, for bank statement analysis, for bureau check and bureau analysis, for other things. So you do a lot of integration, and then based on all those inputs and the bureau input, then you decide upon the credit evaluation, and then you decide the loan amount which has to be given. And all these things are done by the machine itself. So nobody is doing it. That's why it is done instantly, and then the loan is sanctioned. And then, as Rohit said, that you can get the e-sign done, and then you can disburse the loan immediately. So that's why the fintechs are coming on, and that's why the traditional NBFCs are partnering with fintechs so that they can also leverage this technology and increase their book size and reach out to the more customers and then disburse more loans.
So we are running very late, in fact. So I would like to do one last question, and I would like to understand the importance of data security and the cyber security, how it is implicating the NBFC business, and how the panels see the data security and cyber security.
In today's time, when lot of data is moving from one place to another, even the post-COVID era time, where the hybrid mode of working is operational in few companies or most of the companies, or whereas in the fintech companies where the data is being stored on the clouds and data is being captured from the mobiles of various customers, and it is being put up into the central server. So and the IT security is a tremendous task for the IT team peoples, considering the network security, because it is a network security. The company is having a various equipments from servers, printers, or VPNs, and any lacuna in those security features give an opportunity to the hacker to plug into the company's role and steal the critical information. The another is the application security, which is important. All the applications needs to be primarily updated. Like Windows are releasing patches on a quarterly basis. Even if you are using the mobile applications, every time you got a pop-up, the new application has come up, because the service provider are regularly reviewing the security features, and if they found any bug, they are incorporating and addressing those bugs and releasing the new patches. And the endpoint security is also an important function where the end user needs to ensure, if someone in your company is working from home, whether all the security features are enabled on his laptop if he is working from home. Because if you have secured the company servers and everything, but endpoint applications are not secure, then the hacker can reach out to the company database through that system. And the data security, even all the companies are classifying the data into the various categories, uh, like public, private, confidential, restricted, and based on the data classification, the limited access is being given to the respective employees of the company or to the departments to ensure there is no data leakages, and the data is used by the person who's supposed to use those datas. And the second and foremost important is the cloud security, since most of the companies are taking the backups of their database on the clouds for the BCP planning, the business continuity plan purposes. So the entities has to ensure that similar controls are built up there. The data which is being transmitted to the clouds in the encrypted form, it's a two-way encryption where the data is first encrypted in the company's premises, then it is going to the cloud, and then it get encrypted. In case of data intercepted in between the transition, the hacker should not get any information or the critical data of the customer.
Yeah. Thank you, Sanjay Singh. Sanjay ji, I think we have already exhausted our time. So thank you very much for the input. And audience, thank you for the listening us. So the outcome of the discussion, what is coming out is, though there are challenges in the growth path of for the adoption of the regulatory framework, but it's very essential for the long run of the business, and that is being taken very positively. The ecosystem, the other government initiatives is supporting companies to achieve the challenges well within their budget and time. Thank you very much.